Thank you. Good evening. I think I started with good morning and now it's good evening, right? And I think this is the last session of the day. After this, we have a gala awards and Mr. Abhinav Bindra is going to come and talk about the victory innovation and we're going to felicitate the innovators of the BFSI space. So I'm sure everyone is looking forward to that as well. But let me tell you, this is going to be a very, very interesting topic because I have been writing about digital lending since really long. People, in fact, criticize me for writing on digital lending because I wrote articles like buy now, don't pay later, when the industry came with buy now, pay later. And in fact, in my morning speech, as I said, that BFSI is coming with so much innovation in the digital lending space that they're offering you on products love now, pay later, specifically on the Valentine's Day. So Samir, before I begin, there is a small incident that I tell you that I operate from a Kamla Mill office where it's a very famous for partying, right? A lot of clubs and pubs and restaurants. So once I had a meeting with a banker who came to meet me. And in the restaurant, when you were talking, we didn't know how time passed. And after maybe 1.5 hours when we came out, he saw lots of people there in the Kamla Villa and says, oh, it's a different world. I says, but you shouldn't be surprised. He said, why? I says, you are the one who's financing them. They're all BNPL. So that's the crux of the digital lending, right? Today, if most of the youngsters having iPhone, it's not because most of them are sponsored by their parents, but also they have bought it on BNPL as a product, right? So, or they have borrowed loans. So I would like you to tell us to begin with, Samir, since everybody's talking about digital lending, RBI recently cracked down on the digital lending apps, MEITOI and the vigilance agency is also going very high because there is a China involvement. How do you see the whole digital lending shaping up in India and what kind of difference digital lending has made to a bank like you?
Sure. So firstly, thank you for having me here and thanks everybody for joining the session. So I think as you set the context, Amol, digital lending has been associated with a certain type of product, which is a little unfortunate. Actually, digital lending can be of any nature, right? So as an example, if we take our bank, we've defined digital as something that is end-to-end digital, which means neither in sourcing nor in processing a human being is involved. Today, on the lending side, 20% of our disbursals happen end-to-end digital. And 55% of our disbursals happen assisted digital, which means that there is maybe a call center or there is maybe a person who's coming to you, but the loan is given to you fully digitally. These are very standard loans. So average ticket size of 3.5 lakhs, and we are giving it to salaried customers, and delinquencies are very, very manageable, and and so on and so forth. For us, this has worked out very well. By the way, today we have the ability that any citizen of India can come to our app, apply for a loan, and get it digitally, without any paper, without talking to anyone, without meeting anyone. So how have we been able to do this? We've been able to do it because of the public infrastructure that has been built. So as an example, we use video KYC for KYC. We use the account aggregator to get the bank statement of the customer. We use e-sign, e-nash to sign the agreement and set up the repayment and so on and so forth. So we've been able to stitch this together, and today anybody in the country can apply to us, get a loan, and much like they would have earlier gone to the branch or they would have gone to a salesperson. Our digital lending is, it is very, very helpful because of a few reasons. So one, customer experience on digital lending, like we measure NPS. NPS of digital lending is 30 percentage points higher than physical. 30 percentage point, not 30%, right? So if the NPS in the physical world is 50, then the NPS in the digital world is 80, right? So the customer experience just shoots up dramatically. So number one, that's a big source of advantage. Second, we see that actually we are able to run very different types of programs in the digital world compared to the physical world. So we are able to underwrite using many different data sources, etc. And so we are able to actually, our risk-adjusted pricing is higher. So it's kind of better economics for the bank. And we also see that as it stands today, delinquencies are better compared to the physical world. So it's it works very well for the customer, it works very well for the bank. So, we are very, very keen on to see how this entire space progresses.
Sure, quite meaningful Samir, so I would like you to tell us more about the underwriting process, the risk parameters that you find. Because most of the fintech companies operating in digital lending space claim that they have the greatest data and algorithm in place, which can actually underwrite on hyper personalization model, right? They know where somebody is parting, how much money is spending, and whether he's a potential candidate to repay or not. In fact, few of them also use psychometric tests and says that if somebody is wearing a red shirt, perhaps chances are high that he will not pay, right? He will not pay back. So tell us more about what makes you confident while lending these people instantly.
Yeah. So look, the best predictor of whether a customer will pay in the future, the single best predictor that whether a customer will pay in the future is, has the customer paid in the past? Yeah. You can build all kinds of algorithms and so on and so forth. Those algorithms will try to mimic that behavior. But there is no better predictor than this one. So in underwriting, you have to do two things. First is you have to determine whether the customer has the, kind of the willingness to pay, or quote unquote, whether the customer is underwritable, right? And second, you have to figure out what is the ability of the customer to pay. So, you may be a great customer, you may be, you may have paid everything, but if I give you a 500 crore loan, I'm not sure you'll be able to repay it, right? If I give you a 5 lakh rupee loan, I'm reasonably sure that you'll be able to repay me, right? So I have to ascertain both. So you have to figure out the income of the customer, and you have to figure out the ability to the willingness to pay. And the models kind of try to do both. The reason that we are comfortable with our digital lending is twofold. Number one, because we've been lending for many, many years, we built models that help us understand the creditworthiness of the customer. And those same models run on our digital products. It's not like we are now, looking at whether you're wearing a red shirt or a green shirt. We are looking at your banking statements, we are looking at your credit bureau, we are looking at that type of stuff, right? We have tried to impute some of these things through alternate data. So as an example, we partner with some e-commerce companies, and how you transact on e-commerce gives additional insight on top of your bureau score. It gives additional insight. So the model is sharper, right? If we have a partnership with a telco, so your usage of telecom gives additional insight on how creditworthy you are, what is your income, etc. So our base models get enriched using this data. And so these models tend to be more predictive compared to what we were doing in the physical world. If we just did, let's take your e-commerce data and forget everything else and kind of now give you a loan, I'm not sure how predictive that will be. And so our comfort comes from the fact that we have some learning. We looked at historical data. We built models on that data. We are enriching that data. And that gives us the confidence that these things will work. And by the way, we've been doing it for 5 years now. And the delinquency has worked out. And by the way, our annual reports are public, right? So we can't even hide stuff. So you can see what our delinquencies are.
Sure. Meaningful, Samir. So, friends, I really have lots of questions, as I said, because this is my favorite topic, digital lending. But if you have any questions, please be ready. I will ask my team to come with a mic after the question that I will just ask to Samir. So be ready with your question, be very crisp, and I will take your question. So Samir, you mentioned about dispersal risk parameters. In the beginning, we spoke about how the whole introduction of the digital lending. How the collection mechanism works, because everybody's pitching one story that we are lending, maybe in 30 seconds or maybe 3 minutes, right? Nobody's saying we're recovering in 2 minutes or maybe 2 days, right? So how does that work? And if you could give me more highlights about how that whole partnership model works in recovery, not the dispersal, because that we fairly understand.
Sure. So see, collections at the end of the day, collections, so okay, let me put it this way. Underwriting, you can do fully digital. Collections will always be enabled by digital, which means that there will be a certain set of customers for whom you will necessarily have to reach out physically, right? So what we have done on collections is that on the digital front, There are some collection models that help us identify customers to, who will self-cure versus reach out on their own, and versus those that we need to start, calling and so on and so forth. Second, so see, one of the things on collections is that if you enable the customers multiple options to repay, the probability that they'll repay is higher. So we've enabled collections on BBPS, we've enabled collections on multiple other apps, we've given multiple digital means for the customer to repay. But at the end of the day, if somebody is moving, let's say 15 days, 20 days, 30 days delinquent, then the physical collection, which means the kind of the telecalling and then subsequently physical collections, etc., is mandatory. And I don't think that's going anywhere. So collections will be digitally enabled. It can give a impetus, it can improve the productivity, but you need to have, particularly for unsecured, you need to have a strong collections arm in place, which can early detect and early resolve cases.
Yeah, quite interesting, and thanks for sharing that point, because we know that ultimately collection can't happen on just WhatsApp message, right? So thanks for adding that. So I have a couple of more questions, but maybe I will take a pause. If you have any questions, I will, involve you and maybe get answers to your questions. So anybody has any question? Sure. Can we have a mic there in the third row? Can we have a mic there?
Yeah.
Just go ahead. Let's see whether you're audible. Yeah.
Yeah, I think it's a great question. And it's a question that we ask ourselves, and also, by the way, occasionally the regulator also asks us. Because if you read the digital lending guidelines, one of the need is that biases should not creep into the models. See, I think at this point we are a little early for biases, because we are not, at least like we as a bank are not overweight alternate data. We are looking at most of our, like I would say 60-70% of our model is based on very traditional parameters. We look at your bureau score, we look at your income, we look at your salary, and so on and so forth. We'll add stuff on top to do some more analytics. So at this point, we are a little early. But one of the things we do is we have what we call model revalidation. So every fixed period, it could be a quarter, it could be 6 months, it could be a year, we have to go back and kind of look at models and revalidate. And there we try to see that is some kind of, non-credit bias creeping in, like any demographic or any age or any geographical space. We are seeing any this thing.
Any thresholds for that, sir? For revalidation of models, sir? Any metrics for thresholds? Means if these thresholds hits, so the model has to be rechecked and revalidated, sir.
On the credit side, it is very clear, because we have delinquents like. The Gini coefficient of the model, there is something called Gini, which is a little technical, which is how predictive the model is. And so every 6 months you can go back and see in the last 6 months how good or bad my model was based on the delinquency that came through. And basis that, some parameters get dropped, some get added, some get tightened, some get loosened, and so on and so forth. That's very, very standard. On the bias side, till now we've not seen any, so we've not had to do any. But there again, I think if we see like a certain demography, we are seeing the model is rejecting more or accepting more, then we have to do something.
Sure, thank you. Any other question? Anyone else has any question?
This one at that corner.
Yeah, sure. Can we have a mic there?
Yeah, hi. I just had two questions basically. I heard that you mentioned when a customer already has a credit, giving them a loan becomes easier. So you have a bureau thick and a thin customer, wherein you have a history available for them. What about new to credit customers? What are the assessment parameters other than the alternate data that you have? So this was one of the questions. The other one is, when we talk about digital lending on the retail space, it becomes little easier. How about on the SME side? How do you see digital lending, how helpful it is or how easy it is to have digital lending on the SME space? These two things.
Yeah. I think both fantastic questions. So first on the NTC, the new to credit. So see, new for us. So if you think of a bank, it's a 2x2. There is existing to bank, which means he's my saving account customer, and new to bank, and there is existing to credit and new to credit, right? So somebody who's my customer but new to credit, I have ways to underwrite, because basis we can build some models basis savings account behavior or current account behavior, or if they have some other product basis that behavior, and do something. If somebody is new to credit, and so we have, by the way, a third category, what we call known to bank, which is the customer may not be my customer, but I may know something about that customer because of a partner or because of some other reasons, right? So if we know something, like through partners, we do serve NTC customers because we build some models that we can get some confidence. Obviously, our approval rates are lower, our ticket sizes are lower, and so on and so forth, but we are able to underwrite them. If there is somebody who's completely new to credit and we know nothing about them, then we will be very conservative. Then we will do very specific type of products. Like we do gold loans as an example, right? There are, some confidence is there that it can work. Or we will do smaller ticket products and we will get them into the funnel. Like we do credit cards, new to credit, we do credit cards. And then we try to, over time upsell them. So that's the approach we take. The good news is that today, credit penetration is actually quite good in India. If you look at the bureau base, it's already like 250 million odd customers are there. So the new to credit, obviously there is a long tail which has to come in, but it will happen over time. The SME question, see digital today, by the way, you hear a lot about consumer lending in digital space. I think 3 years from now, you will hear a lot about digital lending in the commercial, not even 3, maybe in 18 months from now, you will hear a lot about digital lending in the commercial space. It's a space that is, so if you think of it this way, between 2005 to 2018, into the size of India's consumer lending business across the industry in 2005 is the amount of digital lending that Axis Bank did in 2017, right? And we are a 5% player. So you can imagine the growth that happened in that space in those 10, 15 years. The same is likely to happen to commercial in the next 10 years because it's a space that is extremely underpenetrated from a credit perspective. What is happening is that you are having, so why is it underpenetrated? Because it's difficult to underwrite. It's expensive, you don't have data. With GST, account aggregator, all of these things coming in, the data transparency is going up quite dramatically. And the formal ecosystem is expanding quite dramatically. So in the next 2 years, I think you will see a lot of new models evolve on the commercial space, either direct lending or lending through some kind of supply chain. Already lots of interesting activities happening. It will see scale in the next, I will say, 18 months or so.
Sure. Any last question from you before I move on to my 2 questions? Anyone else has any other question? Okay, sure. So, Samir, let me come to these 2 very important questions now. I mean, we cannot miss the regulatory aspects now when we specifically talk about digital lending because RBI has actually cracked down and asked regulated entities like you to monitor the whole behavior of the fintechs and specifically LSPs, loan providers, service providers. What is the impact that you see on the digital lending business going ahead? Because ultimately, most of the fintechs or LSPs have worked for you as a lead generator, right? And maybe on a commission basis or a revenue sharing. But considering now you will monitor them far more aggressively because central bank has asked you to do that, do you see a huge impact maybe on a whole business of digital lending? Or how do you see the impact of regulations translating into the ecosystem?
Yeah, sure. So see, firstly, as context, the digital lending guidelines, if you look at it, actually, I think it's a starting point for the regulator, and I think you will see the same happen elsewhere. What has the regulator said? The regulator has said the following things, right? I mean, I'm now simplifying hugely, so please take it with that grain of salt. So one, they've said that, look, if you want to do regulated business, please be a regulated entity, right? So you cannot lend if you are not a bank or an NBFC, or if you don't have a lending license. Point number 1, right? Point number 2, if you are in the lending business, or if you are in a financial services business, you have to be fair to the customer. And so transparency and, knowledge of where the money is going, etc., all has to be there. And 3, system stability is critical. We cannot, allow shadow banking to emerge. Broadly, this is what they've said. Now, there is nothing kind of dramatically new here in the sense, obviously there's a guideline, but without the guideline of you, also if you went and spoke to the regulator, they would have said the same thing, right? Like there's nothing, it's not any of these things. So, if you look at our relationships with the fintechs, even pre-digital lending guidelines, they would have followed all these parameters. However, there were a large kind of group of fintechs who were operating in a gray zone, if I may call it that. And I think what will happen, and though that gray zone was bound to, create issues at some point. What the regulations have done is that they've clamped down on these areas. And I think what will happen over the next 12, 18 months is that these regulations will get implemented in true spirit. And we will see further, quote unquote, clamp down, right? Or if I were to put it another way, we will see further cleaning up and, the industry becoming more customer centric, more responsible, and more regulatorily compliant. Which in the long run is...
So if you allow me to interpret and ask you a straightforward question, does that mean most of the fintechs operating in digital lending space will shut their shops?
No, I don't think so. See, I think, so there is some statistic which said that there are 6,000 fintechs in the country, right? And if you look at these fintechs, there are fintechs which are like really good, have great founders, good tech teams, very progressive, want to do right by the customer, want to do the right business, etc. And then there are companies which are, neither fin nor tech, right? So I think what will happen is the proverbial separation of the wheat from the chaff. And the next 18 months will test the industry as a whole. But I do believe that we will have a bunch of very good fintechs emerge out at the end of these, who will then scale and who will be very strong, who will grow the industry, who will penetrate credit to the end customer and so on and so forth. Much like NBFCs have done. NBFCs went through the same life cycle, or MFIs went through the same life cycle. That there was a mushrooming, then regulations came in, a bunch of folks kind of, disappeared. But then a bunch of folks figured out way to do business in the right way, and they have done incredibly well for themselves and for the industry.
Sure, noted your point, Samir, and that comes to my last question, which is again the title of the topic is. So henceforth, we discussed how it started, what's happening right now, what are the major challenges. Regulatory is also quite aware about what's happening and they have issued the guidelines. So given all these aspects now, what next for digital lending? Or if I put it, phrase it like this, what is the future of digital lending? Do you see banks will also automate the whole retail segment digitally? Do you see that most of the banks have started in a fractional manner, but also they will automate or maybe digitally lend to corporates, SMEs, MSMEs far more aggressively going ahead? So how do you see the whole digital lending, the future of digital lending?
Yeah. So I think the future of digital lending is incredibly bright, right? The future of certain business models which were trying to do a few things may not be that, it may be quite bleak. But if you think about digital lending, which is a consumer wants a loan and gets it fully digitally, the future is incredibly bright because of 3 reasons. Reason number 1, the public infrastructure that is being built in the country. UPI, obviously, we know what it has done. Aadhaar and video KYC, we know what it has done. And now account aggregator has come in, it's going to scale up, and that is going to do some incredible things as well. So number 1 is that the public rails that exist are incredibly strong and incredibly at scale, and they will just drive digital like nobody's business. Number 2, consumer awareness and comfort with digital is at a different level now versus let's say in 2019. And so when I joined the bank, there used to be this notion of a digitally native customer. There used to be a lot of so much percentage of our customer base is digitally native, and this type of customer is a digitally native customer, this type of customer is not. You don't hear this today. There is no digitally native customer today because everybody is digitally native, right? So the customer adoption of digital has gone up quite dramatically. And third, the ability of institutions to provide loans digitally has gone up dramatically. It will go up even more dramatically. So as an example, as I said right in the beginning of the of this discussion, that today we can give a loan to anybody in India digitally, right? Anybody. And I think we did not have this capability even 7 months back. So it's only now that we built it. And I think capabilities of this nature will just keep coming in. And so irrespective, regulations is only strengthening the area, by the way. It's not weakening the area. It is only strengthening the area. And so the future of digital lending in my mind is incredibly bright.
Sure, sure, Sameer, for that note. And I think we are absolutely on time. Thank you so much for sharing this perspective here and making us aware about not only the trends, but the future of digital lending. And thank you so much, dear friends, for listening to us very, very patiently. And please stay back and join us for the Excellence Awards as well. Thank you so much. Back to you, Fraser.
Thanks, Amol, for having me.
Thank you.